Hi everyone, I'm Ahmed Pirzada, and this video is part of the MSc unit on International Finance and Economics at the University of Bristol. So in the next 20 minutes or so, we are going to think about money. We are going to think about what money has been historically, where does it come from, and finally we are going to look at what it really means in today's world. So let's start from where it comes from and what it is. So we know why we need money. So we need money to exchange goods. We need money to keep an account of how much perhaps we owe someone or how much someone owes me. Let's say you are working somewhere and you provide X number of hours. How do you keep an account of how much that person owes you in return for the number of hours you have provided? And money serves that purpose very well. And importantly, in doing so, it helps us achieve efficient allocation of resources. So we'll be discussing this a lot later on in this unit. So historically, different commodities have been used as money. It has not always been gold and silver, as some might think. In Sparta, iron was easily available, and therefore they used iron for that purpose. In Abyssinia, salt. In Venice, they also used salt. Shells along the coast of India, dried cod, tobacco, sugar, and so on. And these are just some of the few examples. There are many examples of people using, or societies or communities using, different commodities for the purpose of exchange, for the purpose of unit of account as money. It's not something which is ancient. In recent times, if you look at South Sudan, because of the civil war and so on, people have been using cows or livestock as currency. So they have used the livestock to buy properties or the real estate and so on. So as ancient as the concept might sound, it still exists with us in different societies or communities. What about the currency as we know it today in the form of a banknote, for example, 10-pound note or 5-pound note and so on? So that the history of this also goes back quite a bit. So the first time we hear about banknotes is in China, and that's in 7th century. It wasn't very common until after 600 years when the Ming Dynasty actually replaced coins with paper money completely. It didn't last too long because that led to hyperinflation. The dynasty ended up issuing too much of it. That caused prices to rise, and therefore the paper currency became worthless, and the system actually reverted back to what it was before. Then from 8th century onward, we also see something similar, not exactly what we have today, but we see checks, or you can think of these as the paper currency being used quite frequently in the Islamic world by the traders. As the empire expanded, it became much more difficult for traders to actually carry a sack of coins from one place to another to buy and sell whatever they wanted to trade in. And instead of that, what actually emerged out of the system was that you can actually deposit your gold or silver, whatever currency exists at that point in time, in one city at one of the exchange. You can get a check in exchange. You can go to another city. Perhaps, let's say you deposit the check. You get a check in Bukhara. You deposit your money over there. You take it to Baghdad, and in Baghdad you can cash it, get the money out, and then use it to buy and sell whatever you wanted to sell, right? So this was something which emerged over there and was used quite frequently as trade became much more common. Then we come to Europe, and in Europe we actually see banknotes emerging out of the goldsmiths. So people used to keep their gold and silver with the goldsmith, and rather than carrying it around for the fear of safety, it became much more common later that you can actually use the receipts which the goldsmith had issued you against the gold and silver you have kept with them, and use it for payment purposes. Now, none of this in the Islamic world and the Europe, it wasn't really the government which was making this happen. It was something which was coming out of convenience, right? The inconvenience of carrying gold and silver or coins from one place to another, or the safety of it. Those were the reasons which actually led to the emergence of these alternate means of transaction. In the Islamic world, you can think of check. In Europe, precisely, you can think of receipts issued by the goldsmith being used as currency or money. Unlike in China, where it was really the government which made it compulsory for the people to use it in around 11th or 12th century. I'm not exactly sure of the date, so do check on those yourself. Okay, then the next question, which we still haven't discussed, is why do we even have it? Where does it come from? So normally if you open a textbook, a standard economics textbook, so I've got this slide over here from Bank of England, so even the explanation over here. So you see a traditional story that money actually emerged from barter. What is barter? Barter is, let's say I want to buy bananas, I've got apples, someone sitting next to me has bananas, but that person does not want apples. So how do I ask that person to sell me bananas? So perhaps I go to the person says they need oranges. So I go and find another person who wants bananas but has oranges. Sorry, who wants apples but has oranges. So I give that person my apples, get the oranges in return. I come back to my neighbor, give the oranges to my neighbor, get the bananas, and the transaction gets completed. Now you can easily see it becomes very complicated all of a sudden, right? So in order to get out of this complexity, this inconvenience of finding people who need exactly what you have to offer and who also have exactly what you need, this is very tedious, a very tedious process. So to get around that, perhaps money was invented so that things or transactions could take place much more conveniently. But it turns out that there's not much evidence of this ever taking place in human history. So there's a statement by an anthropologist, by Carolyn Humphrey, who actually says it very explicitly that no example of a barter economy, pure and simple, has ever been described, let alone the emergence from it of money. All available ethnography suggests that there has never been such a thing. So that opens a question then, if money did not emerge from barter, then where did it come from? Why did humans ever need money to start with? There are some possible explanations. So some of the possible explanations suggest that perhaps money works as memory. Money is a substitute for knowledge of previous actions. So what do we mean by that? Imagine a small society, a village, a gift society, to make matters simple. So over here, no one buys or sells anything. People produce different goods, and then they keep on offering those goods to other people as gift. So let's say you need something and your neighbor has it. So you go to the neighbor or get the message across directly or indirectly, and the neighbor has that thing in surplus and the neighbor gives that to you. So you don't have to give anything in return. It's a simple gift, but you know that the neighbor has been nice to you. So sometime in the future, when the neighbor needs something which you have, you are going to offer that good to your neighbor, right? And the same thing happens throughout the village, and the economy functions like a gift economy. But what happens when the society becomes bigger? What happens when people start going out of the village or more people coming from outside to the village? What happens when you start interacting with people whom you might never be able to meet again? So it becomes much harder to keep a memory of who owes whom how much, or how much you owe to your neighbor, or how much you owe to person X who came to the village once, offered you a gift, and then you are never going to meet that person again. So in that sense, perhaps money emerged as an instrument which can help us keep track of previous actions. Money emerged as an instrument which can keep track of memory. So for example, if currently I've got 100 in my bank account, so that essentially means that the society as a whole, because of the transactions or the favors I've given to everyone else, the society as a whole perhaps owes me something which is worth 100 pounds or whatever I've got in my bank account, right? Or if someone is in debt, that essentially means that people or the society as a whole has done different favors to them, or they have taken favors from the society and perhaps they owe to the society this much in amount. So money becomes a convenient instrument which we can use to keep a memory of everything which happened in the past as far as human transactions are concerned. But then again, this is a hypothesis, this is a theory, so don't take this as something which has been proven beyond doubt. But interesting nonetheless, right? So there is some anthropological evidence of this in this book by David Graeber, who basically discusses how if we go back to the Mesopotamian Empire civilization, we actually find that the temple administrators back then used to use silver shekels as instruments to keep track of what was coming into the temples, what was going out, what was being kept in room 1, and in room 2, and so on and so on, right? So over there, silver shekels were actually used as an accounting device to keep track of what was coming in, how much was coming in, what was going out, and so on and so forth. Okay, so this is about the history. This is about what money looked like in history, how it changed its form over time. But what about the present world? Now, the present world is very different, surprisingly. The notes and coins we have been discussing until now, they only make up 3% of what we call money in today's world. The rest is actually made up of reserves. I'll come to this in a while, and the bank deposits. So these deposits are what you keep at your bank account. So you have an account at Lloyd's, whatever you keep in there, whatever is in your account, that's also part of the money supply. And that is really what you know as money, right? In addition to notes and coins. Now the notes and coins and reserves together, they're also known as the legal tender, right? Or they're also known as the base money, or M0. So together, notes and coins and reserves are part of the legal tender. What do we mean by legal tender? That means when you're offered, let's say if you want to sell something and someone offers you that they want to pay you in this, you are legally bound to accept it. So if you walk into a shop and offer buy goods worth £5 and offer them a £5 note, then legally they have to accept it. Okay. But then what are reserves? No, it's important to understand reserves if you want to understand the financial system. No, reserve, just like you have an account in a bank. Now, banks also have an account at the central bank, at the Bank of England in the case of UK. And just like you use your account to make payments to each other, banks use their reserve account at the central bank to make payments to each other. So let's say you tell your bank, let's say Lloyd's, to make a payment to your friend who has an account at the HSBC. So just like you have done that, you have made a payment, the bank, Lloyd's, in order to make a payment to HSBC, the bank Lloyd's is going to use their reserve account at the central bank to make a payment to HSBC by transferring money from their reserve account to HSBC's reserve account. In practice, they are going to tell that to the central bank and the central bank is going to do it for them. But that's the idea over there. What else? The other thing you can use reserve account for is essentially, let's say if all of a sudden, let's say it's Christmas time, many people are going to use the ATM to take money out for different reasons or for travel purposes, then essentially you want to make sure that you have enough cash or notes and coins, let's call them cash, in your bank branches. So you go to the central bank and you tell the central bank that you have got this much in your reserve account and you want to withdraw X amount in the form of notes and coins. And you do that, you bring it, you transfer the currency or the cash to your branches and you make sure that you have enough notes and coins to meet the needs of your customers. Okay? So that's the second purpose of the reserve account. So together, both the reserve account and the notes and coins form the base money M0. Now, base money, this is also something which is in the control of the central bank. Right? This is when the central bank increases the notes and coins in the market, then essentially that's the money supply. So which goes up. So normally when some of you who have studied economics, when you might have heard that the money supply goes up, that the central bank is following expansionary monetary policy or contractionary monetary policy, and therefore they end up changing the money supply. It is this money supply which is what they are changing. Okay, and you can see over here, historically, if you go back, if you go before 2008, you see that reserves were just a negligible proportion of the base money. Over here, base money is made up of the light blue and the dark blue. The dark blue is currency, and the light blue is reserves. This gray bit is something else. So you can see over here, historically, reserves were almost a negligible proportion of your base money. But after the financial crisis, reserves have increased a lot. Now, it obviously raises a question, why is it that banks are keeping so much money in their reserve accounts at the central bank? Okay. Just remember this fact, and we'll come to this later in one of our other videos. Okay. But it is important to remember that things have changed after the financial crisis. Now, reserves do make up an important part of base money, which wasn't the case before the financial crisis. Now, we see the same thing happening in the UK. So you can see that this is again the base money. The graph is not as nice as what we had for the US over here. But you see the same pattern over here, that after the financial crisis, the base money supply has actually gone up or has increased exponentially. And again, once again, most of this is because of an increase in reserve balances of the banks at the central bank or at the Bank of England. Now, interestingly, an important part of the money supply is not notes and coins, as we have seen here, but it is bank deposits. And bank deposits are normally known as bank money. Or Tobin, in his 1963 paper, also termed this as a fountain pen money. So we'll discuss this in a next video. Why or what does it mean by a fountain pen money? But essentially, note that this is an important part of money supply, rather a much bigger part of money supply as we know it today. And you can see over here that for the same period, when the base money supply was actually increasing exponentially, the bank money or deposits are not changing much. They fell, recover, stay almost around the same. Right? They have been increasing. They were increasing before the financial crisis and after the financial crisis. But for the period of the financial crisis, they remained almost the same, with some decrease and increase during this period. Okay? And this is important to remember for later, because historically, money supply or different indicators of money supply move together. They are very much correlated. So if base money supply goes up, broad money supply also goes up, right? So let me say it again. So the money supply together, let's say the notes and coins, reserves, and your bank deposits, together they are normally known as broad money supply. Okay? So historically, broad money supply and base money supply, they move together. But you can see in the financial crisis, the link actually broke between the two. The base money supply increased exponentially, but the broad money supply almost did not change by much. Okay? So this is the graph for broad money supply. So this is essentially this plus this. And you can see over here that during the financial crisis, the broad money supply is not increasing by much, or it's increasing on average by much less than by what it was increasing before the crisis or even after the crisis. So something really happened over here in the financial system, that the link between the base money supply and the broad money supply actually broke down. So we'll come to that in one of the other videos, perhaps the next one. So this is the graph, which is basically showing you the same thing. So the colored lines over here, they are plotting different indicators of money supply. So for example, the dark blue line over here, this is simply the notes and coins. The light blue line over there, this is the broad money supply, M1. M2 is another indicator of broad money supply. This includes many other types of assets which are classified as money under M2. M3, M4 then are an even broader classification of money supply, which include even more assets which are illiquid relative to what we have got over here. So for example, deposits which you cannot easily withdraw because you have kept them in the savings account and so on. They are less liquid. Because they are less liquid, they are normally not included in M1. They'll be included in M2. Even less liquid or illiquid assets will be included in M3 and M4 and so on, right? So the closer you are to M0, the more liquid the assets are, and because they are more liquid, they are more likely to be used as currency or as money. Okay, so but the overall idea is that all these different indicators for money supply essentially move together with each other. Right? They are correlated with each other, some more than others, but broadly they are correlated with each other. Except during the financial crisis, which is what I just showed you before, when the relationship actually broke down. So remember that, and we'll come to it later. Another thing is obviously that money supply is also very much correlated with nominal GDP, not real GDP, nominal GDP. What do we mean by that? So nominal GDP is, let's say, how much you spend, or how much everyone spends in the economy. Say you go to Sainsbury, you spend £20, and that's essentially part of the nominal GDP. So let's say you spend £20 to buy one basket of goods. Someone else spends, let's say, £40 to buy two baskets of goods, and so on and so forth. So if you sum them up, that's essentially the total expenditure, total spending in the economy, and you can think of that roughly as your nominal GDP. So you can see over here, the more money people have, the more notes and coins, the more bank deposits and so on, the higher the nominal GDP is going to be, because you are spending more, right? But keep in mind, nominal GDP is not the same as real GDP. Imagine, for example, all of a sudden money supply increases, but at the same time, the price also goes up. So say next time you go to the Sainsbury again, but this time you buy the same basket, not for £20, but for £30. So nominal GDP will actually go up because now you are spending more. But the real GDP, it's still the same because you're still buying one basket of goods and services. Okay? So it's important to remember that the money supply is very much correlated with nominal GDP, but its effect on real GDP, it's much more nuanced. Okay? So you have to be much more careful about when thinking about how an increase in money supply may affect the real GDP. Okay, that's something which we'll be discussing later. So that's it for now. So overall, what we have tried to go through in this session is have a very quick look at what money has been historically, what role it has played, discuss some of the propositions on where it might have actually come from, why did we even need it to start with, and then discuss what do we mean by money in the modern society, in the modern financial system. So in the next video, we'll look at the financial system in more detail. We'll look at how banks interact with each other. We'll look at how the central bank intervenes in the markets and why. And then perhaps we'll also look at, let's say, some aspects of the monetary policy. So thank you very much. I'll see you in the next video. Take care. Bye-bye.